Welcome, everyone. My name is Leonore Ailing, and I'm the Executive Director of the Center for California Studies. And we're housed at Sac State, the fabulous Sac State. Fingers up. Most people know the Center for the Capital Fellows programs, four programs that we run for recent college graduates who want to learn and serve for a year, working in one of the three branches of California state government. And by the way, the deadline for applying for that program is Monday, in case you're interested. But we also support applied research programs like the research we're going to hear about today. And because we're part of the CSU system at large with its vast network of wonderful faculty, we get to partner with faculty from all over the state. So today we're lucky to hear from two up-and-coming faculty from Cal State LA, both of whom work on research related to policy and its effects on poverty in California and Los Angeles. So Dr. Ellen Shiau is an associate professor of political science, again at Cal State LA, and Dr. Devika Hazra is associate professor of economics. We're going to hear today about the research they've done on income inequality and the effect that public policy can have in lessening the effects of a recession. This research was funded by a grant the center received from the Bill and Melinda Gates Foundation. And I'll let them take it away.
Thank you very much. Thank you for joining us today, for those of you in person and also those live streaming. We're really happy to be here. And a special thank you to the Center for California Studies and Leonore for supporting our research and giving us this opportunity to share what we've been looking at in the last year. I am Ellen Shiau, and Devika is over here. And so we'll go ahead and get started. We know that inequality is a persistent issue. It's a pressing issue in California, also in the United States. PPIC has documented that there's growing inequality in California over the last 40 years. We know that incomes in California grew 58% for those who are high earners, 30% for middle earners, and 19% for low earners. There's a lot of debate, though, in terms of what actually contributes to inequality. There's several ideas, several theories that are supported by different streams of research. And one of the ideas, for example, is that we're seeing changes in technology. And with changes in technology, that requires higher skilled workers. And the thinking is that, however, in the United States, there has been insufficient support for education to prepare the workforce to meet the demands in terms of the changing demands. And so that's one reason that many scholars argue contributes to inequality in the United States. There are other arguments as well. So for example, other scholars have pointed to that executives for corporations are being compensated at significantly higher levels in recent years. And also this coincides with our federal income tax bracket, where our top marginal income tax is now about 37% as the top rate. And this has down from a high of more than 90% in the 1940s. And 70% in the 1960s. And so many scholars have pointed to just the changes in terms of our federal income tax structure that has led to inequality. We also know that inequality is marked by race and ethnicity, where we have differences in inequality along lines of race and ethnicity. And we can trace those differences to discriminatory and racist practices in the history of the United States that have led to unequal access to higher education, unequal access to well-paying jobs, unequal access to homes. And so these have had persistent and long-lasting effects. And so Devika and I were particularly interested, given that there are multiple factors that can contribute to inequality, we are particularly interested, given that we all went through the global pandemic together, and it got us to think in terms of what really are the effects of recessions and economic shocks in terms of inequality. The literature has, demonstrated that recessions can have a significant effect in terms of inequality. However, that effect can be varied and it can differ depending on the type of the economic shock and also depending on the institutional response in terms of the government. As an example, following the Great Depression, we actually saw income inequality decline following the Great Depression. And part of the reason was because of the effect of the Great Depression, where it lowered the incomes and the wealth of top earners. But a big reason also is because of the federal response in terms of New Deal policies and also tax reform that led to a decline in inequality. And so in looking at the two recent economic shocks and the two recent economic recessions, we were curious in terms of what happened in 2008 versus 2020. What were the institutional responses in terms of the federal and state responses in 2008 and 2020, and did they actually make a difference? And that really was our big question in terms of what actually happened and what were the effects. And we were interested in kind of, using this comparison to really understand and learn in terms of, what can we do in terms of policy to address future economic shocks. We know that we can engage in policy learning when we're in the midst of a crisis, where we can actually, make changes and respond to things that we're learning during a crisis. We can also learn in between crises in terms of what we did before, what we want to do in the future. And so that's really the goal of our research in terms of learning about, the effects of these two different economic recessions and the differences in the policy responses. Just to give you an overview, I'm sure many of you are familiar in terms of the characteristics of the two recessions, but you can see that they have very distinct characteristics, which affects how the recessions actually play out in terms of inequality. We know that in the 2008 recession, it went from 2007 to 2009. However, in terms of the 2020 recession, it was fairly short, just a couple of months in terms of the official, designation for a recessionary period. We knew that in 2008, of course, it was driven by the housing market crash, largely due to the use of high-risk lending and predatory lending practices. And in contrast, in 2020 recession, of course, driven by the global pandemic, where a lot of industries that relied on in-person engagement were affected, and so particularly the service industries. And then we saw in 2008 recession that the recession actually had different labor impacts. So it disproportionately affected middle wage workers, because middle wage workers are more closely tied to construction and manufacturing, which was hard hit by the 2008 recession. Also affected racial ethnic minorities and men. In contrast, in the 2020 recession, we see that the recession disproportionately affected low-wage workers who were affected by, the impacts on the service industry. Also, racial ethnic minorities were impacted, and women, because women disproportionately make up workers in the service sector, and also because women bore, more of the burden in terms of childcare for school closures and daycare closures during this period. We know that in the 2008 recession, there was a significant impact on homeowners in terms of foreclosures. However, we also know, and this was under-recognized during the 2008 recession, that the 2008 recession actually had a significant effect on renters as well in terms of increasing vulnerability and housing instability. But very little policy was actually directed towards renters during this period. In contrast, in the 2020 recession, there was acknowledgement that renters would be significantly affected, given that service workers and low-wage workers were more likely to be renters than homeowners. And there was a less effect on homeownership given the unique housing dynamics going on during the 2020 recession. And so those unique housing dynamics were that, home prices were rising, we had historically low interest rates. And so this created, less, of an impact on homeownership, although homeowners were still at risk for housing instability and still faced those issues. But because there was equity in their homes, there were more options in terms of, responding in 2020 versus in 2008. And then finally, we see that, following the 2008 recession, we see a long period of economic growth, and the 2020 recession was fairly short. In terms of what we know so far, in terms of the impact of inequality on the impact of the 2008 recession on inequality, basically what we've seen in the literature is that for a small period of time, inequality was modestly declining following the 2008 recession. because of the institutional response, because of the federal policies that were instituted. However, this was short-lived, and shortly after policy responses ended, we saw significant increases in inequality. And you can see one statistic and one study found that between 2009 and 2012, the top 1% of incomes, they fully recovered the effects of the recession, and their incomes increased 34.7%. For the bottom 99% of incomes, they barely started to recover at the end of 2012, and only their incomes increased only 0.8%. So we see this growing income inequality following the 2008 recession. We also see growing wealth inequality following the 2008 recession. And much of this was tied to the loss of homes. So we saw that for wealthier households, their wealth was tied to the stock market, and they saw significant declines in wealth following the 2008 recession, but their wealth recovered fairly quickly. However, for middle-class residents and middle-class homeowners, their wealth was tied specifically to their homes. And so when they lost their homes, it had a significant effect in terms of their ability to amass wealth. And this had a particular effect in terms of minority homeowners. In terms of the 2020 recession, we're seeing also some similar trends where there is some initial evidence to suggest that inequality is widening following the 2020 recession, given the impact on the service sector and the low-wage sector. However, when we take into account the institutional response, the federal response, what we're actually seeing is that inequality is actually reduced in some initial analyses. And the initial analyses have suggested that without the federal response, we would see inequality increase. We're also seeing, measures of economic recovery, and we're seeing a more equal recovery where people across all income groups are seeing recovery within the first 20 months, post 2020 recession. And we saw that in 2008, it took a much longer time for lower income groups to recover. However, one of the big takeaways, which we'll talk more about, is that policy really had a meaningful effect following the 2020 recession. And however, there are still questions in terms of the long-term effects, given that those policy responses are now, pretty much ended. And so it still remains to be seen in terms of the effect on inequality of the 2020 recession. Here's something to kind of demonstrate the possible policy effects, and I think this is a really, really interesting chart. This is from the US Census, and they're looking at poverty rates, official poverty rates and supplemental poverty measures. The supplemental poverty measures takes into account other factors, including the tax structure, and so you can see that, following the 2008 recession, we can see that both the official poverty rate and the SPM, they were increasing. And so the official rate was 12.5% in 2007, increased to 13.2% in 2008, continued to increase in 14.4%, and we really didn't start seeing declines until about 2010. What's really interesting that you see in 2020, and it's a very clear distinction in terms of the trend, what we're seeing is that the official poverty rate, there was an uptick between 2020 and 2021, but from 2021, 2022, the official poverty rate basically stayed the same. It didn't change significantly. However, with the supplemental poverty measure, which takes into account the tax system and tax credits that were instituted during as a federal policy response, what we're seeing is for the first time, the SPM becomes lower than the official poverty rate, and it reaches a historic low in 2021. And so this is notable because many people are pointing, the census also points to that the reason that we see this significant decline is that it's tied to the policy response of the federal government. However, as we can see, then after the federal response ends, we can see, again, an uptick in terms of the SPM, in terms of measures of poverty. And so we're back up 12.4%, which is actually higher than pre-pandemic levels. And so again, I think we're going to have to keep looking moving forward to see the effect of the accession in terms of inequality. What's also really interesting is that if you take a look at child poverty, there's also really interesting trends. The trends look very similar to this trend. And in 2021, child poverty reached the lowest level on record at 5.2%. And so this went down from 9.7% from the previous year. However, in 2022, it's back up to about 11.5% as well. And so again, it's it's clear that some of the federal response had a significant effect in terms of addressing economic, stability and inequality, and we'll see where things go moving forward. So what did the federal government actually do in terms of, why was there such, a massive change in terms of poverty levels, using this supplemental poverty measure, looking at child poverty as well? Why did we see this drastic change? And so we, wanted to catalog in terms of what happened following the 2008 recession and what happened following the 2020 recession. And so what we found was that, generally after the 2020 recession, benefit levels were significantly higher compared to the 2008 recession. Eligibility was significantly expanded compared to the 2008 recession for several programs. I can give you some examples for unemployment insurance. In 2008, following the 2008 recession, unemployment insurance was expanded to an additional $25 per week. In 2020, unemployment insurance was expanded to up to $600 per week. In addition, eligibility was expanded. So following 2020, part-time workers, self-employed workers, gig economy workers, they were all eligible for unemployment benefits, and they were not eligible following 2008. And so some of the big effects that we're seeing in terms of economic stability seems to come from this broad expansion of unemployment insurance. And the evidence also demonstrates that this expansion of unemployment insurance didn't have a significant disincentive in terms of work, meaning that people, because we had these unemployment insurance expansions, it didn't disincentivize people from actually working. Another example is the expansion of the child tax credit. And so in 2008, one child, you could get a tax credit for $1,000, a tax credit of $1,000. And following 2008 recession, they expanded that to households that made a minimum income of $3,000. In 2020, the child tax credit was expanded so that households that made very little income or even no income qualified. And they expanded the benefits, so children under 6 were allotted a $3,600 tax credit. Children 6 to 17 were allotted $3,000 tax credit. And what was interesting was that following 2020, the federal government divided up that tax credit up as a monthly payment as opposed to a lump sum. And that seems to also had an important effect in terms of promoting economic stability, because people tended to spend the money differently compared to a lump sum refund. And so we're seeing that these, very generous, massive kind of expansions and things, the safety net programs and tax credits, likely, had a significant effect in terms of reducing poverty, stimulating economic spending, and really, supporting economic stability. We see some really interesting differences in terms of housing policies between the 2008 and the 2020 recession as well. We can see that in the 2008 recession, there were a number of programs, but generally these programs were focused on preventing foreclosures and assisting homeowners who are underwater on their mortgages. Most of these programs were fairly small in scale. Most of them were all voluntary, meaning that lenders had to be incentivized to actually participate. Some only applied to certain states, so if you lived in a state where it didn't apply, you weren't eligible. Many of them had very stringent eligibility requirement that required a lot of documentation that also probably discouraged some participation. And so, in terms of looking at all of these programs, a lot of the conclusions is that some of them were on the right track in terms of being effective, in terms of affecting, being able to prevent foreclosures, but they were very small in scale. They came, too little, too late. In contrast, in 2020, we see, a very widespread response to actually promote housing stability. We see mandatory measures like mortgage forbearance, foreclosure moratoriums, eviction moratoriums that were mandatory. We saw that eligibility requirements were broadened and tried to make easier with less documentation that was actually needed. We also saw that a lot of assistance programs expanded to renters, and this is new compared to 2008. And so, paying particular attention in terms of the eviction moratorium and emergency rental assistance, although these programs came later and were as a result of advocacy in terms of people saying that, more attention needed to be paid on terms of housing stability for renters. And so you can see that, the stark differences in terms of the institutional responses between 2008 and 2020. When we look at the California institutional responses, we see some really interesting differences too. First of all, we see in terms of the level of federal aid to state and local governments, there was a massive expansion from 150 billion in 2008 to 500 billion in 2020. And so this gave states, a lot more resources to play with. And, the federal government laid out specific guidelines in terms of one of the goals was to ensure equity and to consider equity when dispersing the funds. We saw in 2008 that California was in a very different fiscal context, right? There was a budget deficit, and so there wasn't, California was constrained in terms of what it could do. And so, largely California participated in several federal programs, and these are all federal programs. However, the state did pass some state foreclosure prevention laws that basically increased the cost of foreclosure for lenders to try to encourage lenders to actually negotiate with borrowers in order to avoid foreclosure. And the evidence demonstrates that these foreclosure prevention laws were actually effective in terms of preventing foreclosures. And so, one example of the laws is that it put in a 90-day moratorium on foreclosures. And so to encourage, again, more of alternatives to foreclosure. We can see that in 2020, there were different policy responses from the state government because of the stronger state fiscal context with the budget surplus, plus the infusion of federal money. We see that the state, took steps to fill the gap. And so, for example, we had tax credits and stimulus payments that were eligible to ITIN filers to be able to provide benefits to undocumented households with undocumented immigrants. We also see a lot of policy innovation with trying new housing programs and experimenting with them. And so, it's clear that, despite the constrained fiscal context in 2008, the state still was able to do meaningful things. But with more resources in 2020, the state was able to fill gaps and engage in some policy innovation. So, we have several policy lessons learned from our report and our findings. I'm going to share, just seven of them with you today. And we have more in the full report if you're interested. But one of the big, takeaways is that we really see that federal and state policies really can soften the effects of recessions in terms of decreasing poverty, promoting economic stability, stimulating the economy. And these interventions largely stem from safety net programs. And these safety net programs, in terms of the expansion of safety net programs, have been very effective in terms of blunting the effect of economic recessions. In the absence of these programs, we probably would see, a greater effect in terms of increased levels of poverty and slower economic recovery. However, what we also saw from the 2020 response was that the response was very swift in 2020 compared to 2008. There was speed, there was scale in the response. However, there were some trade-offs. In terms of being able to get resources out quickly, eligibility requirements were very broad. Documentation often was not required, and so this helped to get benefits out very, very quickly. However, the trade-off was that for many programs and policy experiments that the government tried, many people ended up getting benefits in some programs that might not have actually needed them. So, for example, with the Paycheck Protection Program, that was an $800 billion small loan program, a small business loan program that required minimal documentation and just that businesses had to attest, to hardship from COVID. And so what the research has demonstrated is that many small businesses who received those loans probably would have still survived without those loans. Also, those loans largely benefited business owners and did not really trickle down to benefit employees. And so there's been a lot of criticism of the Paycheck Protection Program and the thought that needs to be, revisited and that more targeting is needed in terms of ensuring that policies really benefit those who are in need. Another example is economic stimulus payments. When they're broadly distributed, what the research has found is that higher income households, they tend to save those payments and pocket those payments. And so as opposed to lower income households who actually spend those payments, it contributes to their economic stability, and it actually helps to stimulate the economy. And so there's some argument that those economic stimulus payments would be more efficient if they were better targeted. 3, we can see that the policies to facilitate housing stability following the 2020 recession were largely very effective. There's evidence to show that mortgage forbearance actually prevented foreclosures. Of course, eviction moratoria prevented evictions. There's initial evidence showing that emergency rental assistance contributed to economic stability for renters. However, we still have to see the long-term effects in terms of housing stability, particularly for renters. There's a particular concern that renters who are under eviction moratorium, they still likely owe back rent. And so in terms of their ability to build wealth and foster economic stability in the future, their ability to pay off those back rent is probably going to come into play. 4, we also found that there were still a lot of implementation challenges in terms of implementing many of these policies. A lot of these policies were not automatic. There were some automatic policies like federal student loan forbearance, but most policies required some knowledge about how do you actually apply, how are you eligible, how do you access these. And so there's evidence that shows that, for example, homeowners who would have benefited from mortgage forbearance, they didn't actually participate in mortgage forbearance. There's also evidence that shows that landlords who would have been eligible for emergency rental assistance, they didn't take part in the program because they were unaware of it. And so there needs to be, more attention to implementation, ensuring that people have access and knowledge of these programs and that they're communicated in culturally responsive ways so that we can increase access and ensure all populations have access. Number 5, I think another important finding is that what a lot of the research has shown is that there was a big missed opportunity during the 2020 recession. Given the historically low interest rates, we saw many homeowners actually, build their wealth by refinancing their mortgages. However, what the research actually shows is that many minority homeowners and also lower income homeowners did not take advantage of refinancing. And so this has implications in terms of an ability for a household to build wealth over time. And some of the reasons for why homeowners did not take advantage of refinancing could be because they were unemployed and so they could not qualify for refinancing. However, there are also other issues and other causes in terms of the lack of access to refinancing. Some of it can be explained by lenders who didn't reach out to lower income homeowners or who preferred not to. And some of it is in terms of homeowners, they were not aware or they didn't think that they would qualify. And so again, this is a big missed opportunities. And so, one of our lessons learned is that, in varying different fiscal contexts, right, we still have to think about how do we increase access to homeownership and wealth through homeownership. Number 6 is the idea that what we see with crises, we see a lot of policy innovation. We see a lot of new ideas, and crises can lead to new ideas and policy innovation. And some of these policy innovations stick and become normalized. And so again, these present important opportunities for us to experiment and also normalize the use of different policy options. So following 2008, there were the adoption of new loss mitigation strategies to prevent foreclosure, and now those are part of the regular toolkit. Following the 2020 recession, mortgage forbearance was not widely used prior to 2020, but now there's discussion that mortgage forbearance might again be another tool in terms of supporting housing stability, with the child tax credit in terms of the significant effect that it had on child poverty. Now there's a lot of interest in terms of, is this something that should be expanded or continued? So there's a real opportunity, I think, to think about in terms of where innovation can actually lead to positive effects in terms of policy. Lastly, before I turn it over to Devika, who's going to share some of our original empirical research, all of this prior research that I showed is based on our review of the literature and our assessment of the literature. Lastly, I think it's important to remember that states can also play a significant role in terms of the economic stability of communities. And the fiscal context can matter. But even in restrained fiscal contexts, states can do important things that will, that will benefit the situation. And in fiscal contexts where there are more resources, states can fill the gaps in terms of the federal government response, and states can also engage in some new policy innovation. So now I'm going to turn it over to Devika, who's going to talk about our empirical findings.
Right. Hello, everyone. So in the next part of the presentation, I'm going to talk about the empirical analysis of the project. Specifically, I'll compare and contrast the effects of the 2008 and 2020 recession on housing affordability and access to housing markets in the state of California, and specifically also in neighborhoods in the city of Los Angeles. So for the state of California, we do a county level analysis and we analyze overall trends or trajectories. So we look at averages and how they're trending over time for several housing variables and socioeconomic indicators. We also compare the pre and post effects of the Great Recession and the COVID-19 pandemic related recession. And then for the city of Los Angeles, we look at neighborhoods. The neighborhood council system of the city of Los Angeles designates 99 neighborhoods, and we divide them into 5 groups depending on the percentage of at-risk workers. So at-risk workers are those who work in occupations that are highly susceptible to unemployment when there is a recessionary shock. So these could be workers in hospitality, sales workers in retail, and also personal care and service operations. Okay, so we look at some specific variables, and I'm not going to show everything, but just the relevant ones for today's presentation. For housing market indicators, we have the average home borrowing or mortgage loans, the percentage of loans originated, because these speak to the access to housing market for individuals. We also look at assessed property value, which proxies what's happening with the home values. It's not a close proxy, but it's consistent with what's used in the literature. Next, I'm also going to talk about mortgage to income ratio and rent burden, and compare and show you how these two change over time, and how the cost of housing for homeowners is different for those who rent, and how recessions affect these two groups of people or households. And finally, to shed additional light on income and wealth inequality, I'll also show the effects of recession on income per capita and poverty rate. Our primary data sources are these 3 resources. We use the home loan data provided by Consumer Financial Protection Bureau. We also obtained assessed values from the City of Los Angeles, or the LA County's Assessor's Office. And for all other socioeconomic variables, we use 5-year American Community Survey data, which is provided by the US Census Bureau. Okay. So these are our first set of variables, and this is for county level analysis in the state of California. For average mortgage loans, we see that the trend for borrowing was increasing in the time prior to the 2008 recession. So there was positive trajectory. But during the 2008 recession, we see that there was a negative trend. So there was lower mortgage loans for each individual, right? So people were borrowing less for purchasing homes. So this is cyclical because it aligns with the economic expansion and contraction. But if you look at the total mortgage loans generated within a county, we see that prior to 2008, there was a negative trend, and that continued into 2008, right? So these two together, what does it tell us? That 2 things were happening. One, there was a shifting composition of borrowers. individuals with better credit scores and better existing assets were able to acquire higher loans on an average, and possibly for homes that were more expensive. The other thing that was happening was an increase in subprime lending towards minority and low-income households. So this exacerbated the wealth gap across race and ethnic lines. And we do see that the decline in total mortgage loans was greater for racial minorities during the 2008 recession. Now, if we focus on 2020, we see a contrasting effect, right? So for both average and total loans, there was an increasing trajectory, a positive trajectory. So both average and total home loans were increasing. Now, and then specifically, we see that the increase was higher for racial minorities. So what does this tell us? When the COVID recession hit, we were seeing that the housing market was experiencing a boom, right? And so there was an overall increase in demand for housing, which could have fueled borrowing because interest rates were low. But existing research also shows that there was increase in unemployment rate and exit rates from the job market for Black and Hispanic households, specifically for Black households compared to other racial minorities. So they were experiencing declining incomes, which contributed to which led to lower down payments, which means they had to borrow more. So that's what led to the greater increase for borrowing among racial minorities, right? So again, this result reinforces the idea that a wealth gap was increasing in the state of California, fueled by housing affordability and access. Next, we look at the percentage of loans that were approved. So what percentage of loan applications that were made were actually approved and originated as loans. During the 2008 recession, there was a statewide decline in this, so less loans were being approved, whereas during 2020, the more recent pandemic, we see that there was an increase in the percentage of loans approved, right? And if we look at the racial breakdown, this is interesting because during the 2008 recession, for Black, Asian, and non-white Hispanic applicants, we see a greater decline. So based on race, there was greater decline in the percentage of loans approved for minorities. And also this was specifically seen in counties with higher minority population. Whereas when the housing market was experiencing a boom, we see that white applicants experienced increase in loan approval rates, right? So again, given that percentage of loans originating can be indicative of access to housing market or housing, this difference, this contrast along race and ethnic lines tells us that wealth and inequality not only increased in general, but also along lines of race and ethnicity. Okay. So let's look at what's going on with housing values and home ownership. For home values, we see that during the 2008 recession, counties with significant minority population experienced a decline in home values. This was not happening in general or overall, but specifically for counties where there was a higher percentage of minority households. And homeownership rates similarly declined specifically for minority population. For the 2020 recession, fueled by the housing market boom, we saw increase in home values, but not much change with regard to homeownership. So again, this reiterates the story that the homeownership gap was high, or the homeownership gap was exacerbated during the 2008 recession, and home values, the gap between home values for across several races increased during both of these recessions as well. So related to housing costs, this is where we see some effects of policy. During the 2008 recession, housing cost for homeowners, as seen by mortgage to income ratio, we see that increased statewide, and also the rent burden increased. But specifically for the rent burden, we see that this was driven mainly by counties with Black and Hispanic population. So one thing to notice that we noticed in our analysis is that rent burden increased more than the housing cost burden. So we've seen in previous research that homeowners are better prepared for recessionary shocks. They're more cushioned from recessionary and inflationary shocks. And given that rent burden increased mainly for Black and Hispanic population, this corroborates our previous finding that income inequality or wealth erosion occurred for minority groups more than the white population. And in contrast to the 2008 recession, in 2020, we see that there was no significant change in trends with regard to either cost for homeowners or for renters. And this is where policy played a major role. Because of the policy interventions, the effects of COVID-19 pandemic was moderated and did not impact homeowners or renters as it could have. Okay, so in terms of socioeconomic indicators, we see that during 2008, income per capita declined for all counties as expected, as we've seen. Poverty rates, both individual and family, declined overall, but this decline was specifically driven by minority population. And for 2020, income per capita declined for counties that have a higher than average Black or Hispanic population. Poverty rate, although there was no overall change, where again policy came into play, it did decline in counties with significant minority population, but not in counties with significant Black and Latinx population, which means that this decline was fueled by decline in poverty rates among Asian households. So while the effects of 2020 recession was moderate on income inequality and poverty, there is still room to improve in terms of mitigating the effects for minority population. Okay. So next I'll talk a little bit about the effects of the recession, of the two recessions on neighborhoods in Los Angeles. And the first map here shows us the distribution of the percentage of at-risk workers. So the lighter the color, this lower is the percentage of at-risk workers. The darker the color, the more at-risk workers we have in those areas. And in contrast to that, we also look at the distribution of the percentage of white households. So the darker the color, the greater the percentage of white households. And this two together tells us that the percentage of at-risk workers is negatively correlated with the percentage of white households. So neighborhoods that have a higher percentage of at-risk workers also have a lower percentage of white households and a higher percentage of minority households, which means minority households are more vulnerable to the risks of recession. Okay. So looking at average home loans, which indicates access to the housing market in terms of borrowing, we see that, sorry, just to back up a little bit, we look at 4 different time periods here: the financial crisis, the recovery after the financial crisis, the pre-COVID expansion, and the pandemic recession. And the darker bars, the darker the bar, the less vulnerable the neighborhood, the less number of percentage of at-risk workers. So for overall all neighborhoods, we see that generally borrowing for home loans increased across the 4 time periods, right? Which means that there was increase in demand for homes, increase in the home values, so borrowers had to obtain bigger amount of loans. What's interesting is that borrowing increased significantly more among non-Hispanic Black and Hispanic non-white applicants. So this aligns with the county level analysis, where we see that Black and non-white Hispanic borrowers had to obtain bigger loans owing to lower down payments that they were able to make. Okay. This shows the assessor value per square feet. So it's reflective of home values in the city of Los Angeles. And one thing that we immediately notice is these are less vulnerable neighborhoods, right? So in less vulnerable neighborhoods, we see that over time, the increase in home value has been significantly higher than those of more vulnerable neighborhoods. In general, more vulnerable neighborhoods have lower home values than the ones that are less vulnerable, but over time, they barely experienced increment in home values, right? So this speaks to the deepening gap in home values. And so those living in these vulnerable neighborhoods were not able to accumulate as much wealth driven by home ownership as their less vulnerable counterparts were. Okay. So what's happening with home ownership? What jumps out of this graph for me is that generally across all groups, across all times, home ownership rate has been fairly stable, right? So that means not many people are moving into the home housing market or are not able to. Specifically, we see that home ownership rate is less for Black and Hispanic households, and home ownership contributes to wealth accumulation. So the fact that Black and Hispanic households have lower rates of home ownership is suggesting that there's lower wealth accumulation and increasing wealth inequality across Black, Hispanic, and white households. Okay. So these two figures show us the contrasting effects of recessions on homeowners versus renters. For homeowners, we see that over time, so across these 4 time periods, the cost of mortgage as a percentage of income has slightly decreased, whereas rent burden remains the same, or maybe it increased for certain groups, right? So if you're a homeowner, you are, as we've seen before, you're cushioned from these effects of recession or inflation. So this adds to the widening income and wealth inequality. And finally, we look at poverty rates. As we've seen before, for the city of Los Angeles as well, Black poverty rate and Hispanic poverty rate is higher than average. And although over time, poverty rate has decreased for each of these groups, but it's actually, I was surprised that the difference between lower and higher vulnerable groups is so stark, right? So this is the lowest vulnerable group, and this is the highest vulnerable group, and the poverty rate is significantly higher for the more vulnerable neighborhoods, right? And this is even more so the case for Black households and Hispanic households. So therefore, overall, we see that over time, there has been increase in income inequality fueled by housing affordability in the state of California as well as Los Angeles. So what are the takeaways from this project, from this study? The first one is that there are disparate impacts of each recession on households, on housing affordability, access to housing, poverty, and income. And specifically along the lines of race and ethnicity. For example, during the 2008 recession, there was a stronger effect on the housing market. But during COVID-19 crisis, there was the housing market was experiencing a boom. However, it was mostly evident in affluent neighborhoods and among white households. So overall, rent and mortgage costs increase when there is a recession, but renters experience a greater burden compared to homeowners when there is a recession. However, we do also see that policy does make a difference. So during the more recent COVID-19 recession, policy interventions helped create a safety net, which prevented an increase in the cost of, for both renters and for homeowners. So in the end, I would say that policy does matter, and it has meaningful implications for households and communities, and specifically, it helps towards mitigating the effects of these shocks on racial minorities. But of course, as shown in the analysis, we could do better. But yeah, the main takeaway is that policy does matter. So thank you for being here today. And if you have any questions, suggestions, please email either of us or both of us. And if you would like to provide feedback for this event, please use this QR code. And so this feedback is being collected by the Center for California Studies.
Recessions, because like the 2020 recession was 2 months long, the Great Recession was 18 months long. So how do you compare those?
So yes, that was a concern for us as well. But although the NBER, which defines the recessions, according to it, it lasted for 2 months, but the effects were still being experienced. And we used the data that we had available, which was the U.S. Census Bureau's 5-year American Community Survey, and we basically were guided a little bit by the data availability. But to your point, I think we could look for data that's more monthly and explore the specific effect of that particular time period when there was the lockdown and the pandemic was full on. But yeah, mostly it was data availability. Yeah.
One of the slides you mentioned in 2008, the housing value did not decrease. Do you mean just that year or a few years after? Because we all know 2008
yes.
the next 5 years.
So
housing decline statewide.
So housing, home values did increase in 2020 statewide. What did not increase was home ownership rates.
Yeah, but for 2008,
oh right.
The decrease on incomes with significant minority population. Was it just for that year, or because we all know in the next 5 years housing value decrease?
Yes, it was for 2008-9.
Just
yeah.
So there's a time delay for the shock. The housing value probably didn't decrease in 2008, but definitely since 2009 all the way to 2013 or 14.
Yeah, so we also, I didn't show this on the slide, but we also look at 2008, 9, 10, and then we also look at 11, 12.
Yeah.
And 11, 12, we see that this trend kind of came to a halt. So we didn't see further decrease in home values or home ownership. And if I think that if I go back and look at 2013, 14, 15, I will see these values increasing.
I see, okay.
Yeah. Yeah. Yes. So for California, we could probably go back and for the county level, we could probably go back and use 2006 to 8 data as well, but there is no track level data for City of Los Angeles. So, but yes, existing research does show that the recession, the home values started to decline even before 2008. Which was the official recession date.
Where do you see this research helping the most policy-wise? it's a really broad question.
I think I'll let Ellen answer that because she did most of the policy work.
I think, one of the biggest things is just demonstrating that the policy had some really significant effects. And, I think that's really important to see in terms of the scope of the effect and the kind of impact that policy can have. And so I think, this opens up questions in terms of where do we go from here? We can see that, this massive response led to a significant decline in poverty, right? If that's someplace that we want to go, right, then, is there kind of, opportunity for political discussions about that if that's a goal that we want to accomplish, right? So I think this gives evidence that these interventions do actually work. And so it's just a matter in terms of politically, are we able to get there and do we want to get there? But I think it gives some evidence that, policy can really shape in terms of economic stability and the outcomes for households.
Yeah, and I would add to that so what we see in this research is that policy interventions work during the recession to mitigate the effects on poverty, right? So it provides a precedent for policy-related interventions or policy work, not just during recessions, but also during regular, economic expansions to continue to help, below the poverty line households with resources that help them lift above that poverty line. So not just use policy for recessionary shocks, but also during normal times.
I think one of the challenges for me is a lot of the interventions you're mentioning were actually in 2022, and you're looking at data from 20 to 21. So it's hard for me to understand how you can make the claim that what policies happen a year later made a change in something that happened in 2020.
So there were some of the policies that were in play immediately after the recession, right? The Paycheck Protection Program, the eviction moratorium. I think those helped with, those support the analysis that there was no significant change in the rent burden or the housing cost burden. And we also see no change in home ownership at the county level.
But I mean, Freedom for All was 23, Relief was 22, two of the rebates were 22. So and a lot of the eviction, the rent relief money went out. Actually, still hasn't gone out. So a lot of your interventions on the chart are out of sequence with your with the data.
Yeah, I see what you're saying. So I know the literature looking at the effect of the emergency rental assistance program, that's just emerging now, right? And so we're seeing the effect now. But a lot of the research that we're seeing is looking at the effect of unemployment insurance expansion, looking at the child tax credit. Those were happening, right, 2021. And so that's why we see the significant decline in poverty. So that's, really what we're capturing. And I think you're absolutely right that there's still ongoing interventions that are still, being implemented. And it's going to take us more data, more years out to really see what the effects are. So yeah, that's the challenge too, because that was one of the reasons why we wanted to do this was to kind of get a sense of what was going on, given that there were so many things going on.